So on to our third and final presentation for today. It's titled The Strange Intellectual Death of the Pension Actuary, possibly with or without a question mark. Please welcome Peter Devlin. Peter is a UK actuary who's lived in Germany for the last 20 years. He's been advising clients on international HR, compensation and pensions issues for over the last 35 years and is currently a partner and head of total rewards practice in Germany, heads up Germany's M&A human capital team, whilst also being the vice chairperson of the International Employee and Benefits Association and a board member on the site. So, he's got a lot of time on his hands by the sound of it. Please welcome Peter.
Okay, it's not showing there, so anyway, it doesn't matter. Okay, put a question mark in there. Okay, the question mark looks like a question mark now. Before it was looking at something else. Now, the genesis of this paper was I was actually having dinner with a friend of mine, another UK actuary based in Munich. I won't tell you the name, but some of you might be able to guess who that was. And as part of our CPD discussion, reflective discussion. So that proves one point, that the CPD reflective discussions take place and lead to something. And we had a bit of a discussion about why are defined benefit pension plans dying out. And we had a slightly different view on it. We agreed on quite a few things, but we didn't necessarily. And my view is that there's a sort of intellectual vacuum that's been generated or has occurred. That means that actuaries have perhaps lost the lead in designing pension plans or what their true funding cost is, and that's where the paper comes from. Now, you'd be glad to know in this paper, if I look at it like that, is there are no actuarial figures. There's no numbers. Oh, there are a couple of numbers, but there's no equations. So for this time of the morning, you'll be okay. So we're going to go through. That's the agenda. So if we look at, and also because I'm a UK actuary based in Germany, I'm basically going to compare the UK market and the German market. If you look at corporate defined benefit plans around the world, they exist in Germany, the UK, a lot in the US, or the US is in big wind-up mode at the moment. Yeah, definitely. There are scattered. Japan has basically moved away from defined benefit plans. Netherlands transferred to basically, compulsory to defined contributions. Most DB plans left are not really pension plans. They're more sort of termination lump sums around the world. Yeah, and why is that so? And could it have been different, or could we have a different outcome? And why am I so keen on it? Actually, my view is defined benefit plan is a great benefit to offer individuals or employees. Yeah, it's you can offer good defined contribution, but generally what we've seen is the defined contribution have ended up with lower contributions than the equivalent defined benefit plan. And defined benefit plans are very good. They're a great way of remunerating people. And contrary to what everyone says, because we do surveys, young people and millennials, etc., are actually very interested in retirement plans and having one. It's one of the, for a corporate, it is actually a good way of attracting and retaining employees. But if we look at the membership and see what the current situation is, if you look at the UK, it's clearly on a downward trend. The active members have really fallen quite quickly, and those are the latest statistics. I got that from the pension regulator site, and you can see there's a sort of there's a pretty steady fall going on, and most active employees have stopped. If you look at Germany, what we mean by candidates is i.e. non-pensioners, i.e. deferreds and actual employees. They're sort of growing up, and it's still growing. But my experience from Germany is that many plans, even by larger companies, are actually being closed to new entrants and something else being offered where possible. So it is in long-term decline. The UK is probably nearer to winding up fully going forward. Are we at the end game? And this is not just for the plans, but for the pension actuaries who work for the plans, because without a defined benefit plan, you won't have a pension actuary, except in retirement. So I tried to work out how many actuaries there were in the UK. That was actually not as easy as I thought when I looked through all the statistics on the membership statistics, because, of course, what I'd forgotten is that the definitional changes of actuaries changes over time. So, for instance, at one point in the series, they had insurance pensions or pension insurance. So the definition changes quite a lot. And also, then there was the institute and the faculty joined together, so that sort of messed up the comparison, etc. And then I came to a conclusion, roughly, there are 2,900 pension actuaries at the moment. Yeah. If you look at the Germany, there it was easy. I just got a colleague of mine, and she just sent me the list of DAV with IFRS qualifications, and there it's growing quite steadily. And it's still growing, and which I thought was quite interesting because the actual market in pension actuaries in Germany is not really growing. Yeah? In Germany, the market has been, of maybe 20 years ago, there's a big consolidation in pension actuaries, yeah, to the what I would call the usual three, and others, and then but then it's sort of been becoming a bit more fragmented. But the actual general market has definitely, I would say, fallen a bit as the number of pension plans has not necessarily closed, but certainly got smaller, and technology has made a big difference. So, what factors would have affected defined benefit plans, and how did actuaries react? And I basically clustered this into three areas. So, mortality, longevity, regulation, design, political economy, and finally, the one we all love to discuss the most, the discount rate, yeah? Which is probably the driver of it all. But let's go through them all in turn and see what was occurring. If you look at longevity, you have the UK in 1950, so 5 years after the last war, or global war. Life expectancy there for the UK was 71.13, and Germany 69.004, so not much different, and again now. So longevity is increased, and the point about it is I think actuaries have been really good at that particular area. Yeah, they've always been on top, like understanding mortality, longevity, working it out, understanding the difference on socioeconomic groups. That's really, you could say that's her home turf, and they've done a lot of it very well. And if you're honest, whenever you see something in the newspapers, and when I say the newspapers here, what I mean is the Financial Times in the UK and the Handelsblatt in Germany, because that's the ones I read, and they're what you might call the newspapers of record for finance. Yeah, and so for instance, recently in the Financial Times, there was an article about they'd asked an actuary whether Mr. Biden or Mr. Trump would live the longer if they got into a second term. But I thought it wasn't who cares about the number, but the point was they asked an actuary for that number. Yeah, they didn't go and ask a statistician or anything else like that. They asked an actuary, so we're known for that. Yeah, so I think when it comes to planning and being able to plan into our funding valuation or liabilities, actuaries have been very good at understanding mortality and how it works and projecting for changes. And you've seen it in the Congress going today, that there's a lot of work going on in that area. Regulation, design, and political economy between the two. Now, despite the fact that I was actually, I qualified in the UK, I'd really forgotten how complicated the UK had made everything. And I was really stunned when I started looking it up, because to give you an idea, there are 46 UK Public General Acts, and what that means is a Pension Schemes Act 19, whatever your year is. 46, sorry. I mean, it's unbelievable. When you think about it, if you take those 46 Public General Acts and add up all the regulations behind them, you could probably, and someone can work it out, each page you could pave the way to the moon and back 5 times or something like that. It's a statistics there to be calculated, but it's unbelievably complicated. And I have to say, if it was only for that reason, I probably would have given up designing defined benefit plans. And one of the worst things about UK regulations is they've often backdated things. Yeah, I mean, and the interesting thing is you compare it to Germany. Yeah, first of all, you can't backdate law. It's not allowed under the Constitution. So you could never do that, which is a good thing. And anyway, they haven't messed around with the pension regulations going over the last few, since the war, really. Remember, there are two very different ways of doing pension plans. So in the UK, you rely on a trust system. So you have a separate body that has a trust, you put cash in there, you invest, etc. And then it's regulated as well. In effect, in my view, most trustees have lost all control over it, and it's just a sort of semi-insured regulated system that's going into wind-up now. In Germany, most pension plans, apart from Pension Actuary, are effectively book reserve. What does that mean? It means you just basically give an employment promise, say, we will pay you a pension equivalent to X, whatever the formula is, and there is some legal requirements about it, but not too many. So the interesting thing is in the UK, the difference is you'll get a standard plan when they were still open of 1/60th times your final salary, etc. for life. In Germany, you can get an amazing variety of types of pension plan. You can also, so you can get something from like less than a pizza a week as a result to a very good pension plan, really very good ones. So there's an enormous range of offerings on what type of pension plan you can do. And also, the general law behind it is much simpler. There's no, and it's primarily, if anything, to be said, driven by tax. And also, sorry, I should go back there. Talking about the political economy, I think the political economy of both has been very interesting. I think Germany has been less. There's been lots of discussions about it. There always are lots of discussions about pension, but because most pension comes through the state pension, that's where most of the discussion takes place. Whereas the UK, I think, has suffered a lot from pension plans being over politically regulated or discussed. For instance, after the Maxwell scandal, stealing money out of the pension plan, they completely changed the rules, but what he did was already illegal. In the UK, you can tell there's a very short-termist view of it, in the sense that there is no gain for a politician to be seen to be around when there's a failure of a pension plan, rather than explaining, they'd rather have no plans and no pension plans and no failures, because then they cannot be blamed. Rather than saying, actually, with all systems, you're going to have issues about whether things really happen according to what we'd like to happen, and there will be occasional problems, and maintaining a system. And I think Germany has done better in the sense of just maintaining a view of keeping it consistent. And consistency is what all businesses need, to do everything. So I think the political economy behind the two countries is better. Is better within Germany. They've been more stable in their regulatory efforts. The discount rate, this is the key issue. So when I first started work in the UK, which is too many years to mention, there you were looking more at sort of, what's the expected return on plan assets, and then sort of coming up with a sort of prudent basis on that and saying, okay, we'll discount the future cash flows along that. Along came IAS 19, FRS 17, and basically said, your matching asset is bonds. Effectively, you project the cash flows, it's a bond-like, so therefore you need to price your cash flows in AA corporate bonds, in effect. And that was the great killer of pension plans in the UK and around the world, because it went on the balance sheet. But the point is, and this is critical for what I say later, is that's an intellectual construct. It's not the reality, it's an intellectual construct. It is saying, we're going to accuse it. Now, it does come from a theory in a university, like all our theories do. They come from universities. All our lives are driven by theories that emanate from very clever people sitting in offices somewhere in universities. But it's a theory. But I don't think it was ever really true. And I think many actuaries felt it was untrue. But they didn't seem to be, they felt a loss of influence and a loss of power about it, and have sort of resigned themselves to saying, well, that's the way it is, that's the way it is. But I think we should have been, and this is what my later comments, we should have been a bit more vocal about that just isn't true. And then basically done a sort of a catch-22 of forcing everybody to invest in bonds because corporates have gone, okay, we don't want balance sheet volatility, therefore we invest in bonds. So the price of defined benefit plan has been far too high. So the price goes up, the supply goes, or the demand goes down, the need for it. And that's basically what's happened. The actuaries have done quite a lot of work on budgeting versus solvency. You can see that in the literature over the years within the Institute of Actuaries or around the world. So they have done quite a lot there. So they have been active there. But the key point is the bond the matching asset, and should you have equities in there, has not really been addressed enough. If you go to Germany, it's completely different. There, it's all book reserved. And when you think about what is a book reserve, it's 100% self-investment in equity. Yeah? It's an equity-based fund. Yeah? And the only thing you need to do is under local GAAP, HGB, is just put it on the balance sheet. Until 2009, you used to basically using 6%, the tax rate. Yeah? So it was irrespective of what market values were, 6%. And then they moved it, so they thought, well, we better have something a bit more market-based, but not too volatile. So they introduced a 7-year average and then a 10-year average. Yeah, so the curious thing at the moment is the current market values of HGB liabilities are actually higher than IFRS because the spot market rate has fallen. Yeah, but there was a stability, and the good thing about that in a way, because the average used in HGB was just entirely arbitrary, 7 or 10 years, could have been 15, could have been 12, could have been 5. No one really takes too much notice of it in essence. Yeah, it's just a number, and that has it's sort of obscuring the true cost. But what is the true cost? Yeah, because that's the issue which has helped it stay in place. Who questions the discount rate? I think you can't when you look at what you might call the sort of the intellectual background of the discount rate. There's the general discussions of what is the right interest discount rate for doing liabilities on HG balance sheets. That's happened quite a lot. Should they be using to a spot market rate? Now, I suspect they might be more keener on the spot market rate now that the spot market rate is below the average, but that's a purely tactical move that might happen. But assuming nothing changes, the only places where you can really look at what do people really think the price of a pension plan is, or the discount rate, is in the M&A transactional world and what we call, which is a relative new market, the pensioner company funding. If you look at the M&A transactional world, which I do a lot of, the discount rate is, if you ask bankers, what they think of it, they go, well, US GAAP or the IFRS rate is far too low. It should be much higher. Not necessarily as high as the weighted average cost of capital type argument. So I'll give you an example at the moment. IS 19 is about 4.5%, and then you could have a weighted average cost of capital of 8, 10, 12% if you wanted. So there's two extremes there, but it's somewhere in between. Yeah. So they think that we're overvaluing the liabilities. And if you look at the pensioner company, and a pension company is where you take a legal construct for X employees, yeah, and you put it into a standard GmbH, a limited company, and you fund it, and then you transfer that to an asset manager. And in that case, you can see that the asset managers are doing very fine calculations, like stochastic modeling, basically ALMs, stochastic modeling, and saying, okay, well, how much money do we need to pay the cash flows plus all the corresponding costs? And there you get much lower values than what's held on the balance sheet, because when you add it all together, you can still get it off your balance sheet, maybe for US GAAP IFRS value. Yeah? So therefore, what does that say? We're overpricing the liabilities on companies' books. Come back to the point, we're overpricing liabilities on the company books, which means there are less pension plans, which is a bad thing, because defined benefit plans are a social good. Yeah? We should have more, not less. Yeah? So that's the UK. Germany. If we look at the UK, UK is quite interesting, especially for those who read the Financial Times. There was an interesting argument about 2 years ago about the university superannuation scheme, because they had strikes about, they were being asked to cut benefits or whatever, and pretty well every academic in the UK got out their pencil and paper and started trying to prove the actuary wrong, which I thought was interesting. But what I found most interesting about the entire debate in that articles and the letters that came in and out was it was all being discussed by the main correspondent was Martin Wolf, yeah, but all the people discussing it, writing letters, coming in, none of them, as far as I could see, were actuaries. Yeah? And I thought that was a great missed opportunity for actuaries to say something, even if it was saying, yeah, we agree with you, we are being far too prudent for funding valuations, but we have to do that because the law tells us to do that, so they should change the law. But no one actually wrote that in. I mean, I tried, I did my best, but I didn't get in. Maybe my English is not good enough for a letter into the FT on that issue. But we should have made greater effort, I think, to shape that debate. And that's one of the issues, I think, that's occurring. Again, we're looking at, they referred to Imperial College, etc., so people in universities, but actuaries themselves, in my view, were not being specific enough about or defending not just their own territory for their own purposes, but defined benefit plans, which are a social good. Yeah? They are a great thing. They're disappearing, but it's not a good thing that they are disappearing. Yeah? We're going to end up worse off for it. They're long-term and sustainable if they're done correctly. So I think when it comes to the discount rate, there's a lot of discussions about what the right thing is. For those of you who have not read Andrew Smithers' book, The Economics of the Stock Market, you should go and do it, because there he points out quite clearly that, in his view, that, and he does a lot of economics behind it, that the return on equities is he comes out with a very precise number, which I wouldn't necessarily go for, but it's 6+%, and it's all reversion to mean. So it is a suitable investment for long-term liabilities, and we should be using that type of analysis to allow pension funds, defined benefit plans, even when they're corporate ones, to invest in equities and take reflection of that in the liabilities shown on the books. So the question I put up, have we lost, or are we intellectually dead? I don't mean that at all. Actuaries are very clever. What I mean is that actuaries really need to be much more forthright in spreading their views and questioning what comes out of these great universities. Is that really right? Yeah? Not just be known for mortality discussions, but be known for funding discussions and be more pressing. And I believe actually that's what the institutes should be up there to do, or encourage, even if they can't do it because of their own legal setups, but that's what they should be doing. Yeah? That would be my conclusion. I hope you enjoyed that brief overview of it all.